The year was 2008. The global economy, once a picture of robust health, began to tremble. Like a skyscraper built on shaky foundations, the financial system started to crumble. This wasn't just another recession, it was a seismic event that would reshape the world as we knew it. This was the 2008 financial crisis. At the heart of the crisis lay a toxic cocktail of irresponsible lending practices, rampant speculation, and a dangerous lack of oversight. The housing market, fueled by easy credit and the allure of quick profits, had ballooned into an unsustainable bubble. When that bubble finally burst, it triggered a chain reaction of financial calamities that rippled across the globe. The world watched in disbelief as financial institutions deemed too big to fail teetered on the brink of collapse. Governments scrambled to bail out banks, fearing a complete meltdown of the global economy. The human cost was staggering. Millions lost their jobs, their homes, and their life savings. The 2008 financial crisis was a stark reminder of the interconnectedness of our world and the devastating consequences of unchecked greed. It exposed the flaws in our financial system and forced us to confront uncomfortable truths about the way we live, work, and manage our money. To understand the 2008 crisis, we must first journey back to the early 2000s, a time of unprecedented growth in the U.S. housing market. Fueled by low interest rates and a seemingly insatiable appetite for real estate, home prices soared to dizzying heights. This was the housing bubble. Adding fuel to the fire were subprime mortgages. These risky loans, offered to borrowers with poor credit histories and low credit scores, were seen as a way to expand homeownership. However, these loans were often packaged and sold off as complex financial instruments known as mortgage-backed securities. Wall Street, eager to capitalize on the booming housing market, gobbled up these mortgage-backed securities. They were seen as safe investments, backed by the tangible asset of real estate. But beneath the surface, a crisis was brewing. As housing prices started to plateau and then decline, many subprime borrowers found themselves unable to make their mortgage payments. Defaults mounted, and the value of mortgage-backed securities plummeted. The house of cards, built on a foundation of risky loans and speculative investments, began to collapse. The collapse of Lehman Brothers, a venerable Wall Street investment bank, on September 15, 2008, marked a turning point in the financial crisis. Lehman, heavily invested in mortgage-backed securities, found itself on the wrong side of the housing market crash. As the value of its assets evaporated, Lehman faced a liquidity crisis. It desperately sought a buyer or a government bailout, but to no avail. The U.S. government, fearing the moral hazard of bailing out every failing institution, allowed Lehman to fail. Lehman's bankruptcy sent shockwaves through the global financial system. It was the largest bankruptcy filing in U.S. history, and it shattered the illusion that some financial institutions were too big to fail. The financial markets went into freefall as panic and uncertainty gripped investors worldwide. The collapse of Lehman Brothers was a defining moment in the crisis, highlighting the interconnectedness of the global financial system and the devastating consequences of a loss of confidence. The 2008 financial crisis was not just an American problem, it was a global contagion. The crisis, which originated in the U.S. housing market, quickly spread to other parts of the world through the interconnected web of global finance. European banks, heavily invested in U.S. mortgage-backed securities, suffered massive losses. Countries like Iceland, Ireland, and Greece, with their own economic vulnerabilities, were pushed to the brink of sovereign debt crises. The global economy went into a tailspin. Stock markets crashed, credit markets froze, and international trade plummeted. The International Monetary Fund estimated that the crisis wiped out trillions of dollars in global wealth. The crisis exposed the fragility of the global financial system and the dangers of a highly leveraged and interconnected world. It demonstrated how quickly a localized crisis could morph into a global pandemic, affecting countries and individuals far removed from the epicenter. Section 5. The Dodd-Frank Act. A Band-Aid on a bullet wound? In the aftermath of the 2008 financial crisis, the U.S. government enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. This sweeping piece of legislation aimed to prevent another financial meltdown by addressing some of the root causes of the crisis. The Dodd-Frank Act introduced a range of reforms including stricter regulations on banks, increased oversight of financial institutions, and the creation of the Consumer Financial Protection Bureau, or CFPB. The act aimed to curb risky lending practices, enhance transparency in the financial system, and protect consumers from predatory lending. However, the Dodd-Frank Act has been the subject of much debate. Critics argue that it is overly burdensome, stifles economic growth, and doesn't go far enough to prevent another crisis. Proponents maintain that it is essential for preventing another financial meltdown and protecting consumers. The Dodd-Frank Act represents a significant attempt to reform the financial system, but its long-term effectiveness in preventing another crisis remains to be seen. The debate over its merits highlights the challenges of balancing financial stability with economic growth. Section 6. The rich get richer. Wealth inequality in the crisis's wake. The 2008 financial crisis exacerbated existing inequalities in wealth and income. While the crisis affected people across all income levels, those at the top of the economic ladder were able to weather the storm far better than those in the middle and lower classes. The wealthy, with their diversified portfolios and access to capital, were able to take advantage of government bailouts and the subsequent rebound in asset prices. Meanwhile, many middle-class families lost their homes, their jobs, and their life savings. The crisis also highlighted the growing disconnect between Wall Street and Main Street. While ordinary Americans struggled to make ends meet, the financial industry, which had played a key role in creating the crisis, received billions of dollars in government bailouts. The widening gap between the rich and the poor has fueled social and political unrest, as many feel that the system is rigged against them. It has also raised questions about the fairness and sustainability of an economic system that seems to benefit the few at the expense of the many. Section 7. Bitcoin's rise, a flight to digital safety. In the wake of the 2008 financial crisis, a new form of currency emerged: Bitcoin. Created in 2009, Bitcoin is a decentralized digital currency, operating independently of central banks and governments. Some proponents of Bitcoin saw it as a viable alternative to traditional currencies, which had been tarnished by the crisis. They argued that Bitcoin's decentralized nature and limited supply made it a more stable and secure store of value. Bitcoin's value has fluctuated wildly since its inception, experiencing periods of rapid growth and sharp declines. Its volatility and association with illicit activities have made some wary of its long-term prospects. Despite its critics, Bitcoin's emergence reflects a growing distrust of traditional financial institutions and a desire for alternative forms of currency. Whether Bitcoin will revolutionize the financial system or fade into obscurity remains to be seen. Section 8. Lessons learned. The ghost of 2008 still lingers. More than a decade after the 2008 financial crisis, the question remains, have we learned our lessons? Some argue that significant reforms have been implemented, making another crisis less likely. Others contend that the fundamental flaws in the financial system remain unaddressed. While the Dodd-Frank Act introduced important regulations, critics argue that it didn't go far enough. They point to the continued existence of too-big-to-fail institutions, the complexity of financial instruments, and the persistence of risky lending practices. Moreover, the rise of shadow banking, a vast network of financial institutions operating outside of traditional banking regulations, poses new challenges to financial stability. Shadow banks played a significant role in the 2008 crisis, and their lack of transparency and regulatory oversight raises concerns about their potential to trigger another crisis. The ghost of 2008 still lingers, a reminder of the fragility of the global financial system and the devastating consequences of unchecked greed and risk-taking. Whether we have truly learned from the crisis and taken the necessary steps to prevent another one remains an open question. Section 9. The future of finance, a tightrope walk. The 2008 financial crisis was a watershed moment, forcing us to rethink the way we manage risk, regulate financial institutions, and ensure economic stability. The future of finance will require a delicate balancing act, navigating between the need for innovation and the imperative of regulation. Technological advancements such as artificial intelligence and blockchain have the potential to revolutionize the financial industry, but they also introduce new risks and challenges. Regulators must adapt to these rapid changes, striking a balance between fostering innovation and mitigating risk. Moreover, addressing the underlying economic inequalities exacerbated by the crisis is crucial for creating a more stable and sustainable financial system. This will require a multifaceted approach, including policies that promote inclusive economic growth, reduce income inequality, and provide adequate safety nets for those most vulnerable to economic shocks. The future of finance is uncertain, but one thing is clear: the lessons of 2008 must not be forgotten. We must remain vigilant in our efforts to prevent another crisis, fostering a financial system that is both dynamic and resilient, innovative and inclusive. The stakes are simply too high to do otherwise.